All right. Welcome to today's video. In yesterday's video, we'll just do a quick recap. We looked at the different kinds of financing available to Australian banks. We looked at your savings account. We looked at different kinds of bonds, including senior debt and junior debt, or subordinated bonds. And then we looked at different kinds of equity with preferred equity, which is in Australia is normally known as hybrid securities, and common stock. And we looked at how, as you go down this list, the cost of finance to the bank gets bigger, but the return to the investor also gets bigger. So as you go down the list, you get an increasing risk and return ratio for these investments. And but what I didn't mention is that some of these bonds, there are two different types of bonds actually that can be senior or junior. And that is fixed rate or variable rate. And I wanted to talk about the difference between these two different types very quickly. So variable rate or floating rate bonds change with the bank bill swap rate. Bank bill swap rate, which is related to the reserve rate of Australia. And so the price of these bonds, if you were to sell them on a secondary market, remains very stable for the variable rate loans, because as bonds become more attractive, the yields of the variable rates decrease. But if the bonds become less attractive, then the rates increase. So it keeps the valuation of those bonds on the secondary market very stable. So variable rate bonds have stable valuations. Fixed rate bonds don't have as stable valuations. The bank is taking a risk when they issue a fixed rate bond. If they're issuing a fixed rate bond at 3%, when the Federal Reserve rate is at 3%, they're taking the risk that the Federal Reserve or the Reserve Bank of Australia will reduce interest rates. If the Reserve Bank of Australia reduces interest rates to 1%, then they're now paying 3% on their debt when they only need to be paying 1% if they've taken out a variable rate loan. There's the other risk as well, which is a positive risk, which is that if they lock in an interest rate at 3% for the next 10 years and then interest rates rise to 5, 6, 7%, they've got cheaper finance than if they had a floating rate loan. So it's riskier for both parties, depending on interest rate risk. So less stable and more subject to interest rate risk. More sensitive, let's say. Then of course, hybrids can be also, because although they're technically equity, they act a lot like bonds. So you can have also fixed rate and floating rate hybrid securities. And common stock, of course, they pay dividends as the business decides to share its profits with investors. It's neither fixed rate nor variable rate, in that it's not linked to the reserve rate of Australia at all. It's simply a business decision. Alright, so with that out of the way, I wanted to talk about how we can use some of these concepts to our advantage. So we talked about before how if you have savings, its savings are a product of the bank and it makes you a customer. Bonds are a piece of paper and they make you the bank's business partner. It means you take on slightly more risk, but you get a higher interest rate, so you get a higher return on your money. And equity makes you an owner of the business. So all of the profit that the business makes on the percentage of the company that you own is yours. And as the company grows in value, you could sell the stock at a higher price, or as it passes on profit in the form of dividends, you get to receive that and use it as you wish. So we want to talk about today about how we can use this to our advantage in the current interest rate environment that we live in, to maximize the return on your savings and hedge against some of this interest rate risk that we're taking on. So we're going to talk about a completely hypothetical scenario in which person A has $70,000 in savings account. And let's just say they have it at a figurative Macquarie Bank of Australia, and let's say they earn a 4.75% interest per annum, payable monthly. So doing a quick calculation, this person, and I've done the calculation previously because that's not part of what we're learning today. Beg my pardon. This person would earn, including interest on interest, would earn about $3,300 and just round it to $390 per year in interest. Leaving them with a total at the end of 1 year of $73,390. However, that 4.75% interest per annum is a variable rate. So, if person A in situation 2, if the reserve rate falls 0.5% per year, a moderate fall, they would then lose about $340 worth of that interest income. So then, instead of receiving $3,390 per year, they would be receiving $3,350 per year. So $340 of that interest would be at risk due to a falling rate environment, leaving them with $73,050. So why do I say that? Well, because currently interest rates are at an all-time high. They were raised to combat inflation, and most analysts and businesses and banks and market participants expect rates to start falling. No one's sure exactly when they'll start falling. Some people reckon November, December, earlier or later. No one's sure exactly when because it's completely up to the Reserve Bank. However, most people are expecting them to fall at some point. So that would make a portion of the interest that this person has in their bank at risk of not receiving it in that case. So I want to look at person 2, or person B. Person B has looked at the lessons we've provided on moving from a customer to a business partner with the bank. And they invest their money a little differently. They still carry $40,000 in that at the Macquarie Bank, earning them 4.75% interest per annum. But then they also they've also invested $15,000 in an ETF of subordinate debt, which is also subordinate debt or junior debt issued by banks. And this ETF is currently yielding 5.7% per annum, a whole percent more. And this is debt or bonds. They've also invested $12,000 in an ETF that invests in bank hybrids. So it's a kind of equity, but preferred equity. And that currently yields, it yields about 5%, but most of that income is franked or has tax benefits. So it's actually equal to a pre-tax interest rate of about 7%. And if we want to compare them, we have to use pre-tax. And that's preferred equity. They've also, surprisingly, if you notice that doesn't add up to $70,000, they've also added $3,000 in an insurance policy, which is GG GGAB, which is a geared ETF, which means it's has leverage and uses options trading to invest in 10-year government bonds, which have a higher interest rate sensitivity. So it has no necessarily interest rate, but it's an insurance policy, and the price of that will rise if interest rates fall. So, and if we calculate how much interest this person earns every year, it is about the interest they earn per year totals about $3,735 interest earned every year. So that's just on the first 3 items, which is a whole $400 more than person A is earning. So they earn $400 more per year by elevating a portion of their savings to, instead of being a customer, to being a business partner and a partial owner of the bank. And that income is still very stable. The price sensitivity of sub D, the price volatility is very low. It operates within a very narrow range. BHYB is preferred equities. It operates within a slightly wider range, but still very narrow. Never really more than plus or minus 1% in a year, let's say. But that's why they've invested a smaller portion of it. If it had exact price, if it had no price volatility and was completely stable, they probably would have invested their whole savings in it, because it's a better rate of return. It's a 7% rate of return. But that plus or minus 1% annually in its price, it's in that volatility, is the reason they haven't invested the whole amount in what gets them a better return. So this has been optimized for stability as well as return. Because isn't that one of the reasons we enjoy putting our money in savings? Is we know that if you put $70,000 in your savings account today, you can take out $70,000 tomorrow because it's got absolute price stability. And so they've optimized for price stability. Person B is also optimized for price stability, but earned an extra $400 per year. Well, not exactly 400, about $345 per year extra over person B, over person A. So extra income. Even without investing that $3,000 in a thing somewhere that will be interest earning. So that's in situation A. If interest rates stay the way they are, person B will earn more interest income than person A. But what about if interest rates fall? Well, person A then has an interest rate of might have an interest rate of 4.25% in their bank. So they'll lose about $300 worth of interest income, which we calculated earlier. Yeah, so they'd lose about $340 if they're in interest income per year, if there was a fall in the interest rate of 0.5% of the reserve rate, and that rate was passed on by the bank to the savings account. Over this side, if there was a fall in the interest rate of 0.5%, the savings, you would also reduce your income very slightly. But we have an insurance policy here, and if the rate of interest was to fall by 0.5%, the price of 10-year government bonds would increase as they're higher yielding and fixed rate. So the price might appreciate by 15% of $3,000, which is about $450. So you've hedged the amount of this person B has hedged their income. Not only do they earn $345 extra, even if interest rates stay the same, they also have hedged their income against falls in interest rates. So as the interest rate falls and they earn less interest income, the price of their insurance policy will go up. So that interest income is then protected. And so you wouldn't necessarily invest $3,000 in GGAB all at once. So you can invest $750 at the start, and then each time the Reserve Bank of Australia decides, okay, we're not going to drop interest rates yet, that price might fall a little bit. So then you can invest another $750 at that point. And then if the Reserve Bank of Australia then decides that the next month or the next meeting that they're not going to drop interest rates just yet, that price might fall even further. So you can add another $750. And then again, one last time, until you've invested $3,000. And then you'd leave it at that, because that's how much you've decided to put in. So just to summarize, $70,000 in savings at Macquarie Bank, 4.75% return, will earn $3,390 of interest per year. But that interest is a variable rate, so it's at risk if the Reserve Bank of Australia decides to cut interest rates, and the interest rate cut is passed on to savings customers, which it normally is immediately. And it might be, it's at risk at a rate of about $340 per year for each 0.5% cut that the reserve rate does. The Reserve Bank cuts interest rates. This strategy over here still has $40,000 in savings, earning 4.75%. It has $15,000 in an ETF of subordinate debt, earning a greater 5.7%. And it has $12,000 in hybrid debt to Australian banks, which is earning a whopping 7%. So this earns $3,735 worth of interest every year, which is greater than the $3,390 earned over here. It also has a hedge against falling interest rates. So if interest rates fall, it actually makes money, and by a greater amount than their interest is decreased. Because even over this side, hybrid securities, some of those are fixed interest, but some of those are floating rate of interest. So that 7%, if interest rates were to cut, would start to fall a little bit. Not by the full amount, and not by the same amount that it would fall in your savings account, and it would actually start to fall slower. So you earn that greater amount of interest for a slightly longer period of time. The subordinated debt, it's also floating rate, just like your savings account. So it can fall if interest rates start to fall, but again, more slowly than it would fall in your savings account, which falls absolutely straight away when interest rates fall. So anyways, this has been a good video, my second finance video. This is a way in which you could protect your savings from falls in interest rates by investing and putting your money in Australian banks in nice stable ETFs with stable returns. Thanks for watching. Don't forget to like and subscribe.